Hello, and welcome back to the channel. I'm Algabot, and this is where we take automated trading strategies for the MetaTrader 5 platform apart and study exactly how they think. Today we're looking at a strategy called Quartile Skew Reversion, an expert advisor built around a genuinely clever statistical idea, reading the shape of recent price returns to tell a fragile move from a durable one. This is a mean reversion approach, and it leans on the Bowley quartile skewness statistic alongside an EMA baseline and the average true range. By the end of this video, you'll understand the logic, the code, and a full chart walkthrough. Let's get started. So what does this expert advisor actually do? Quartile skew reversion is a mean reversion system. That means it isn't trying to chase a trend. Instead, it waits for price to become stretched a long way from a fair value reference, and then it looks for that stretch to relax back toward the middle. The fair value reference here is an exponential moving average, the EMA baseline, and the amount of stretch is measured in multiples of the average true range, which adapts to how volatile the market currently is. But here is the twist that makes this strategy interesting. Not every stretch away from fair value is worth fading. A big move can be durable, built on broad participation where many bars each push a little, or it can be fragile, where just a handful of oversized spike bars did all the work while the rest of the window went nowhere. The fragile kind tends to relax back. The durable kind tends to keep going. To separate the two, the strategy measures the shape of the recent return distribution using Bowley quartile skewness. Because it is built from quartiles rather than from averages, this measure is robust to outliers, which is exactly the property we want when we're trying to detect a few spikes rather than be distorted by them. The strategy is single time frame and works on whatever chart and symbol you attach it to. The default settings look at a window of 24 close-to-close returns, an EMA period of 30, and an ATR period of 14. It is designed to be selective, standing aside far more often than it acts, because it insists on 3 separate conditions all lining up at once. Who is this style suited to in an educational sense? It's aimed at traders who are curious about statistically grounded, rules-based systems and who prefer a patient, range-focused approach over constant activity. As always, this is educational information only, not financial advice, and trading always involves risk, including the risk of loss. Let's walk through the logic step by step. The expert advisor works on closed bars, so it makes one decision after each bar completes rather than reacting to every tick. On each new closed bar, it does 3 pieces of homework. First, it builds the EMA baseline over the last 30 bars and reads the current average true range over 14 bars. It then measures the slope of that baseline across the last 20 bars and divides that slope by the ATR. This gives a volatility normalized measure of how strongly the baseline is tilting. If that value sits inside the slope guard band, the default being 1, the market is judged to be flat or non-trending. This is the regime filter, and it exists so the strategy never tries to fade a genuine, ongoing trend. Second, it takes the last 24 close-to-close returns, sorts them, and computes the Bowley quartile skew. The formula uses the first quartile, the median, and the third quartile. It's the third quartile plus the first quartile, minus twice the median, all divided by the interquartile range. The result is bounded between -1 and +1. A strongly positive reading means the up returns have a long right tail, so the rally leaned on a few spikes and is fragile. A strongly negative reading means the sell-off leaned on a few down spikes and is likewise fragile. Third, it measures the stretch, how far the last close sits above or below the baseline, compared with the entry threshold of 2 times ATR. Now the entries. For a long, the strategy signals when 3 things agree. The close is stretched at least 2 ATR below the baseline. The skew is at or below minus the skew threshold of 0.25, and the regime is flat. For a short, it's the mirror image. The close is stretched at least 2 ATR above the baseline. The skew is at or above plus 0.25, and the regime is flat. On the exits, the take profit is placed right at the EMA baseline, because the whole idea is a return to the mean. The protective stop is set beyond the extreme, 1.5 ATR past the entry, so that if this turns out to be a real breakout rather than a fragile stretch, the position is closed quickly. Only one position runs at a time. Let's read through the meta editor code on screen. At the top are the input parameters you can adjust. Return window, defaulting to 24, sets how many returns feed the skew estimate. A period of 30 defines the baseline that price reverts toward, and that same baseline becomes the take profit. ATR period is 14. EntryStretch of 2 is how many ATR multiples price must be extended before we look to fade. SkewThreshold of 0.25 is the minimum fragility we demand. Slope guard of 1, together with slope loopback of 20, defines what counts as a flat regime. Stop ATR of 1.5 sets the protective stop distance, and lots is the position size. Below the inputs, the strategy computes stretch, the signed distance of the close from the baseline, and trigger, which is EntryStretch times ATR. Then it defines two setups. Notice both sides are shown. The long setup is true when stretch is at or below minus the trigger, and the skew is at or below minus the threshold, meaning price is stretched down on a fragile drop. When that's the case, the code places the stop 1.5 ATR below the extreme, sets the take profit to the baseline, and calls trade.buy. The short setup is the mirror, stretch at or above the trigger and skew at or above the threshold, a fragile rally. There the stop goes 1.5 ATR above the extreme, the take profit is again the baseline, and the code calls trade.sell. Let's bring the whole idea to life on this illustration. Across the top you can see the price candles. The blue line running through the middle is the EMA baseline, our fair value reference, and the two gray lines above and below it are the stretch bands, drawn 2 ATR away from the baseline. In the panel underneath is the Bowley quartile skew, our fragility gauge, with dash threshold lines at plus 0.25 and minus 0.25. Notice how flat the baseline stays throughout. That is the flat regime the strategy requires before it will act at all. Watch the opening candles. Price drifts gently, hugging the baseline, and the skew reading hovers near zero. There is nothing fragile and nothing stretched, so the strategy simply waits. Then on the third candle something changes sharply. Price drops in one aggressive move, punching well below the lower stretch band. This is the kind of stretch the strategy is built to examine. Down in the subpanel, the skew reading plunges to around minus 0.45, far below the minus 0.25 threshold and deep into the green fragile drop zone. That tells us the fall was driven by just a few oversized down spikes rather than by broad, steady selling. Stretched below the baseline, fragile skew, and a flat regime. All three conditions agree, and the buy entry marker appears. The protective stop sits 1.5 ATR below that fresh low, so a true continuation would be closed out quickly. Now follow what happens next. Over the following candles, the fragile drop does exactly what the name suggests. It relaxes. Price lifts off the low, climbs back through the lower band, and works its way steadily upward. By the sixth candle in the sequence, price has climbed all the way back to the blue baseline, and that is where the take profit sits. The reversion is complete, and the long trade closes at its target as price meets the mean. After that, the market settles again near the baseline, and the strategy returns to waiting. Then the mirror image sets up. Price accelerates higher, and on the ninth candle it spikes above the upper stretch band. In the panel below, the skew climbs to around plus 0.48, above the plus 0.25 threshold and into the red fragile rally zone. This says the rally leaned on a handful of up spikes rather than broad buying. Stretched above the baseline, fragile positive skew, flat regime once more, the sell entry marker prints. Here the protective stop is placed 1.5 ATR above the high extreme, keeping the risk defined. From there, watch the fragile rally give way. Price rolls over, slips back through the upper band, and glides down candle by candle toward fair value. As it reaches the blue baseline again, the second take profit is met, and the short trade closes at the mean. The market then drifts quietly around the baseline, with skew back near zero, and the strategy stands aside, patiently waiting for the next time all three conditions align. That's the heart of quartile skew reversion. It doesn't fade every stretch. It waits for a stretch that the return distribution says is fragile, insists the wider regime is flat, aims for the baseline as its target, and keeps a tight, defined stop beyond the extreme in case the move turns out to be real. Remember, this is a simplified, illustrative example for education, and real markets will not always behave this cleanly. So there we have it, a full look at quartile skew reversion. We covered the core idea of telling a fragile, spike-driven stretch apart from a durable one. We walked through the three conditions of stretch, skew, and a flat regime. We read the key parts of the MetaTrader 5 code for both the long and the short side, and we followed a buy and a sell example from entry all the way to the baseline take profit. A quick and important reminder: everything in this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. Trading carries real risk, and losses do happen. If you found this helpful, please like the video, leave a comment with the strategy you'd like analyzed next, and subscribe for more MT5 strategy breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.